People ask me, well, how much time do you spend on the lead left? And my answer is all the time, every day, because in my meetings with investors, in my discussions with my colleagues, in watching Bloomberg, in all of the reading that I'm doing, I come across information that I'm like, this is crying out for us to go to investors to get them to understand what's going on. Welcome to Private Capital Call, the podcast with leaders in asset management, investing, and capital markets. I'm your host, Randy Schwimmer. This week we have a special edition. For our regular listeners, I'm usually the one asking the questions. Today that changes. We have something worth celebrating. Our publication, The Lead Left, is relaunching as The Lead. And I wanted to mark that milestone with a real conversation. And let me tell you, no one is better suited to turn the tables on me than my good friend Paul Sweeney, co-host of Bloomberg Surveillance and Bloomberg Markets on Bloomberg Radio. Paul, take it away.
All right, Randy, thanks. It's great to be here. Where I'd love to start is I'd love for you to take us on this journey from the lead left to the lead. How did this all evolve here? Because you've been doing this a while.
Yeah. I was thinking on the way over here, I started actually writing about private credit. It was then called the middle market, as you remember.
Yep.
In 1993. So 93 started because even the middle market, translating that to both my colleagues in the capital markets desks and then the capital markets business to my middle market colleagues required some education. So I started it was a monthly newsletter back then. Didn't have a name. I think I called it the Middle Market Monthly or something really creative. And then a couple of years later, I was working for Jimmy Lee.
Yep, great.
running the
all-time great.
Yep. And he used to have 7:45 staff meeting where he would go around the table and ask everybody what they were working on. And he would always say, are we on the left? Are we on the left? Like, in other words, are we leading this deal?
Yep.
And after about 6 months of this, one of his assistants, and he had like 3 of them, came up to me and said, Randy, I've got a much better name for your newsletter. I said, what? She said, On the Left.
Yes.
Okay. And I thought, that's really, really good because it signifies leadership and everything else. And, in those days, on the left meant being on the left of the tombstone ad.
Right.
They don't do tombstone ads, I don't think, anymore. But
I still have the Lucite's, though.
Yes.
I still have them.
Oh, you still have
packed
them?
Up in a crate.
Yep. Oh, that's great. Yeah. What are you going to do with those eventually?
They've been traveling around with me all over the country for years.
I think I have the same ones. But whoever was the lead underwriter and running the business was on the left. And so I started actually doing that when we came to Churchill because in March of 2008, you remember the markets were significantly turning. They had started turning in the summer of 2007. And our internal employees needed guidance to tell their clients about what was going on, particularly private equity sponsors. Because we had started Churchill 2 years before in 2006. So this is our 20th anniversary of Churchill. So in 2008, we started what was On the Left, which was an internal document, but somehow got in the hands of a private equity sponsor. And one of the managing partners called me up and I thought, oh no, I've gotten myself into trouble. And he said, no, send it to all my partners. And so I was like, whoa, okay. And then I went to Ken Kinsell, my CEO, and I said, so-and-so called. And he handed me his Rolodex, which in those days was a Rolodex. And he said, send it to everybody on my Rolodex. And so we started off with, 5,000 names, something like that. Yeah. And then I realized it wasn't just my commentary that was going to be helpful in terms of readers' interest, but also getting data into people's hands from a lot of the research agencies that were publishing in those days. So LPC, Loan Pricing Corp, LCD, and others. We eventually got to close to 50,000 subscribers. And I always kept it reasonable in terms of price because I wanted volume and quantity more than income. We weren't publishing to make money. We were publishing for our clients. And so we had a really good run. And then when we went to Nuveen in 2014, 2015, I wanted to sort of rebrand it, recreate it. And Sherry Chen, who had actually worked for my wife before that, and my wife sold her business. And so Sherry didn't have a job. And I said, Sherry, how would you like to come work for me? And so Sherry came over and actually rebranded and relaunched from the On the Left to the Lead Left back in January 2014. And so we restarted with a little different look and with a little more sophisticated focus, I think, on private markets. And so from 2014 until now, we've been doing the lead left, and it's had a great run.
Now for the lead, bring it into the 21st century, multimedia, I noticed,
Yes.
podcast, LinkedIn. Talk to us about that, because we consume content much different than we did 5 years ago, 20 years ago, certainly.
Yeah, and I think that Bloomberg is no stranger to multimedia, and obviously having you guys as one of our sponsors has been fantastic. And I think I get energized every time I come onto your program, the surveillance and Bloomberg Markets. And it's great because having the visual is really important. So we started interviews through the newsletter, but it became clear, and Sherry said, look, let's start doing the podcasts. We were doing it with video, but people said probably better as a podcast because people want to take it with them.
Mm-hmm.
We kept some of the visuals, and it became obvious then as social media took over that people now do want to actually see something. So we've taken the podcast, which is called Private Capital Call, which was actually a LinkedIn feature. They called me and said, hey, we love Lead Left. Can you do something for us that's a podcast? So we created this sort of spin-off, if you want to call it that, or brand extension. And we also do webinars, and that's kind of the Lead Left Presents. So we had the newsletter, the webinars, the podcast. We thought, let's bring it under one umbrella. So we're going to call that the Lead, and then everything's going to be under one umbrella.
What's the source of the content, Randy? Where do you get your ideas? Where do you get your data? Where do you get your all that good stuff?
So people have asked me, how many people work in your newsletter? Because they have this vision of dozens of people because we have all this content coming in from all our third-party content providers and all the written material, and it's every week. It's a lot of work. It's actually historically been Sherry and me, so it's the two of us kind of doing this thing. We've expanded it a little bit in the last few years, but until recently, it's pretty much been this homegrown effort. But the idea has really been to do something which you guys have helped us do, which is to bring the voice of the practitioner to investors. So it's not just journalists. Journalists play a very important role, obviously, and I love the whole journalism idea of reaching out to investors every week with information on what's going on. And we do try to dig below the headlines, but we're talking about the asset class and credit private capital as a practitioner, as an investor, as a builder of businesses. So when we see headlines that don't reflect what's actually going on, we always try to steer it back to, okay, given what we know about how to invest in private credit, here's actually what's happening. And a lot of it, Paul, is kind of syncing it to the other capital markets, whether it's leveraged lending, whether it's high yield bonds, whether it's sometimes public equity markets, and give people a sense for not just what private credit is, but what it is relative to all the other asset classes. So we have tried to create as much content around M&A, around fundraising, private equity, the bond market, so that the reader can not just read my brilliant commentary, but also all of the third-party information that we're getting from a dozen content providers like Bloomberg, like PitchBook, and dozens of others.
So, Randy, you guys have been doing this a long time,
Yes.
bringing exposure to this asset class, but one could argue that the demand for education has never been stronger as it is today because there are retail investors getting greater and greater exposure to this.
Yes.
Talk to us how you think about that part of the content and the education angle of what you guys are doing.
So literally since 1993, I was educating our bankers, right, and understanding how these bankers spread out across multiple branches. And then back at the Chase Manhattan Bank, they didn't know what LIBOR was, Paul.
Yeah.
Okay.
Yep.
They didn't know what price flexing meant, basis points. What does selling in a syndication mean? And so I literally would have to put out, I used case studies. I would have a vocabulary word every month, something to learn. And I became, I like teaching. And as we started going from backwater to beachfront in private credit, middle market turned into private credit, the questions became more sophisticated and the answers needed to be more sophisticated. So as we've seen the asset class grow particularly over the last 10 years, certainly since the Great Recession, what's happened, you mentioned retail, but the institutional market was like retail in that early period. They were not necessarily recognizing private credit as an asset class that they could use because they were used to liquidity. They wanted to be able to trade. They wanted to be able to trade bonds and loans. And many of the corporations that were issuing loans were also issuing bonds. In the private credit world, nobody was issuing bonds. They weren't going public.
Yep.
They were these discrete loans held by, in the early days, mostly banks, but then direct lenders, finance companies. And over time, especially after the Great Recession, what the institutional investors realized was this stuff is great because it doesn't trade down when everything else trades down. That's what they learned through the Great Recession. And you remember when the syndicated loan market dropped by 20%. That wasn't a real discount. That was kind of a sentiment discount. It came back, but people were panicked and they were like, I want something that won't trade down like that. And so over time, the institutional investors became comfortable with the fact that this stuff didn't trade because they had the benefits of this illiquidity, which suppressed volatility in their portfolio. Come along the retail investors, they're coming at it from a different angle. They're coming at it from maybe a real estate angle. They're coming at it from a public equities and high net worth angle where you can, depending on how old you are and your retirement and your family interests, you can have more or less fixed income versus equities. But this alternatives bucket became more interesting when they saw their friends at these large institutional firms taking advantage of it. So your point about education is absolutely spot on. The retail investor is sophisticated, but not in the same way. So they need to understand, what am I getting when I get into private credit?
And talk to us about, I guess, what have been in the headlines over the last several months. It's just the liquidity aspect, which it seems to be a certain level of misunderstanding, a certain level maybe not proper education. How do you try to get that message across and try to explain that aspect of the asset class?
Yeah, weekly. Yeah. And one of the things that drives me about this, doing it every week for 18 years, I mean, that's a long, long time, is I wake up every morning and I think there are investors out there, Churchill investors, who are looking at our asset class, looking at private credit, but they see these scary headlines. How can I get them to read the lead left and have that publication help them understand what private credit is? And since I'm also an investor, since I'm on our investment committee, and most recently as vice chairman, chief investment strategist, and head of our wealth effort, I meet with investors all the time. And so when they're asking me questions like, how much of your portfolio is in AI, or how liquid is your non-traded BDC and so forth, I need to be able to not just communicate at that meeting, but I'm thinking there's hundreds, maybe thousands of other investors that we're talking to that have that same question.
Yep.
So I'm going to take those questions and put them in a series of newsletters, a series, let's say, on a topic like liquidity, and compare liquidity in private credit to public credit. What is the purpose of it in bonds and leveraged loans? And what is the purpose of it in private credit? And since I've been on the desk in both, I've traded loans and bonds at several large institutions, JP Morgan, BNP, and so forth. I know how that works. And so I can intelligently discuss the differences because, look, ultimately, Paul, sophisticated investors need public credit. They need public equity, but they also need private capital, private equity, private credit, because there's a balance, right? You sometimes need liquidity, but there are other times when you don't want it, when you want to put it away and not have it move around. I mean, real estate is the closest example. When we started hearing this discussion about daily NAV, right? Why it made sense, some people said, to have a daily NAV on your private credit portfolio. I was telling people, well, that doesn't make any sense any more than having daily NAV on your home, right? I mean, why? You sort of have a view about what your home is worth. You know what you paid for it. You know what your neighbor sold his or hers for across the street. But do you actually every day need to know?
Right.
No, because you know it's a long-term investment. Same thing with certainly the core middle market in private credit. So that's what keeps me going and writing, and the team, because as we meet with investors, education, it's more than table stakes. It's really what wins the...
You mentioned the core middle market.
Yeah.
That's kind of where you guys play. So how do you guys define the core middle market, and why is it attractive?
Yeah, so it's 25 million of EBIT up to, call it 75 million of EBITDA, which translates to, call it 100 million in revenue up to 500 million in revenue. There are times when those boundaries move a little bit. Right now, for example, you could say that the core middle market might go as high as 100 million because the banks have been sort of out of the LBO market now for a while, just because they don't like holding leverage loans, no matter what they say. They like trading them. They like getting fees off them, but They would much rather syndicate a loan than hold one. And so as that has happened, some of the larger middle market deals have been accessing private credit market. And so we have companies that are larger than 75. But for the core middle market, what we're talking about are companies that tend to be more, I'm calling them now sort of ground level businesses, like pest control or veterinary centers or HVAC or commercial landscapers. The larger you go, the bigger the business is and more like the traditional larger companies that are either public or they're tracked by research teams within large, for example, CLO managers.
Yep.
And those are the companies that tend to be larger than 100 million of EBITDA with real liquidity and ability to issue bonds. And they also tend to be covenant light in those larger. So they have bond-like covenants rather than maintenance covenants. So that 25 to 75 is a nice kind of way to define it.
A lot of folks saying we're in a golden age of private credit, but you're calling it the platinum age of private credit. What do you mean by that?
Yeah. Well, I got nervous when that golden age narrative came out because that makes it feel like it's never going to be better than, right? And the reason it was called that was because the yields were so high. We went from 0 to 5.5% in the Fed funds rate. So you went from, call it 7% to 12% in terms of all-in yields. So people are looking at senior credit and saying, wow, 12%, that's amazing, that's great. The problem is that people forgot about the pressure that it put on your portfolios. And you remember in 22, 23, as the Fed was raising rates, all of a sudden it started to dawn on people, this is not such a golden age because those portfolio cushions in terms of interest coverage were getting squeezed. So we know the Feds started to cut rates. Rates are 350 basis points lower than they were at their peak, which means that 12% is down to like 9-ish%. So there's still a healthy return, and yet now we have much more cushion in our portfolios, which is why we call it the platinum era, because we think that yields are still very high historically compared to history, certainly compared to the 2010 to 2022 period that we were going through when rates were zero. So the rates are high. They're certainly high relative to public credit markets, which, as you know, spreads have been compressing. But the pressures on the portfolio are much less. So we think that this period, which is really resilient right now in terms of great economy, rates are steady, and deal flow is increasing. That is actually a much more durable, and therefore that term platinum comes to mind. Titanium age didn't sound so good. So the platinum era kind of fits what we think is actually a really excellent opportunity for investors.
As private credit's lumped in with private equity, hedge funds into alternative investment places to put your money, which is non-correlated to market. That's one of the advantages that a lot of people see. I would argue there's kind of an anti-AI play to where you guys play, because there's been some pushback recently on this overwhelming AI theme within the broader markets.
Yeah.
And I'm guessing AI is not that big of an issue for some of the companies you look at and the industries you look at?
Yeah, because the AI theme, which has actually been around for a decade and we've been aware of and underwriting for, started to get real headlines with the very large hyperscalers, right? And so we saw the Magnificent Seven representing 40, 50% of the market value. And when investors saw that and they started to see that the same thing was going on in the credit markets for those very large companies, there was this concern eventually, as we started to see the potential of a recession, the potential of AI actually undermining some of these very large companies or companies like them, that people were starting to look into the portfolios of the larger private credit managers who were trafficking in that large space and asking questions like, how much of your total portfolio is dedicated to AI? And the answers were pretty significant because these larger managers were playing in these momentum sectors. We at Churchill and others in the core middle market had been always focused more on kind of plain vanilla defensive sectors. We call them old economy or ground level companies who are being bought by private equity firms who are looking for opportunities to consolidate within regions, within industries, to build small companies and make them bigger and therefore exit at a higher multiple. And so, as it turns out, many of these defensive industries that we started investing in, under the Churchill banner in 2006, that actually went through the Great Recession, also went through that 2010 to 2012 period where people were not sure whether we were going to have another recession. Remember the double dip discussions?
Yep.
2013, 14, 15 with energy prices skyrocketing, and you had U.S. going from AAA to AA. You had a lot of mini concerns, mini crises, mini macros going all over the place. And then obviously we had COVID, the inflation boom that hit after that, high rates to kill the inflation boom, low rates coming down, tariffs, Iran, one thing after another. And throughout that entire period, what's happened is this core middle market, these defensive industries sailed through for the most part. And so we just stuck to our knitting. And when the latest AI stuff would come along, we'd say, not really sure what the potential headwinds to that business are. We're going to kind of stick to our knitting. And so the result is like barely 5% of our whole portfolio represents kind of software type of companies. So we like the position we're in. We think that it's been recognized in the market. One of the things that we talked about last week on Bloomberg was our relatively low redemption rates in our non-traded. And I think that's good. That's part of the education, is that now investors are looking at managers who are in core middle market businesses and how they're faring versus everybody else.
That means you guys have to be pretty good credit analysts.
Yes.
Now, I went through the Chase Manhattan Bank credit training program, so I can hold my own with anybody. But when you think about the companies of that size, you really don't have maybe as much room for error as you might with a larger company with lots of other sources of capital.
How does that work?
How does that work for you guys?
So it was one of the earliest lead lefts that we did, or when I had seen some information on default rates for large companies versus smaller companies. It was actually, I think, a Fitch publication, and I was browsing through it, and I was just looking at the numbers, the default numbers and losses for the larger companies versus the smaller and medium-sized businesses, and was astonished to see that the middle market companies' default rates were lower than the large businesses. So I went to Fitch and I said, can you run the math on this? And I'd love to see a chart. And they did. And lo and behold, both losses, and this goes back like 10, 15 years when I saw that, which was 10 years ago. So it's probably been 25 years now, that the smaller companies were actually doing better in default rates. And I thought, how is that possible and why is that possible? So I started to do some homework and realized, and this has been confirmed over time, that in the large market, when company has issues, you can trade in and out quickly, right? Yep. So bad earnings release, quarter comes out, all the holders will trade out at 98, 97, whatever it is, even if it's less than that. In the middle market, you can't. You're stuck, right? So the difference is that in the large market, you've got a variety of people, funds who are trading this paper, some of whom go in at par, some of whom go in at 60 cents in the dollar. The ones that go in at 60 cents the dollar don't care if they get out at 61 or 70 or 78. They just don't want to go out at 40, right? And so you have this split between the kind of vulture funds who just want to get out at whatever north of where they came in versus everybody else. And what happens then, you lose value sometimes when you're trying to fix problems within those businesses, because the holdup value of the vulture funds are like, you know what, we're out. Doesn't happen in the middle market because nobody goes in at 60 cents on the dollar unless you're restructuring the whole thing. They're all in at par. And so they want to all go out at par. So the reason that the default rates were lower was because these core middle market lenders work together to come up with strategies to figure out a way to get out at par. And so they're much more tolerant of taking their time, contributing equity if needed, working with the private equity sponsor to fix these things. And so over the years, what's happened is these default rates in this core middle market have actually proven out that they're better in the long run and therefore more resilient than some large cap companies. And that doesn't mean that you can't get out successfully out of a large syndicated deal. You can, but if you get stuck in one where some folks are trading at significant discounts, that can hurt you.
One of the things that we were all, I guess, kind of figured out since the pandemic is what's the right work from the office versus, working from home and the hybrid thing. That takes me back to what I feel like when I look back on my long career on Wall Street, it's all about the relationships.
Yes.
And the great people I work for and learned from, that mentorship. How do you think about mentorship in financial services?
Goodness gracious. Now you've hit on one of my pet projects, because I do think that it's very hard to learn the craft at home. And there's probably a lot of businesses like that. But particularly this business, when you remember those days, you're on the desk, you're sitting around, a trade comes in or a loan comes in, you sit down with your team members and you sit down with your boss and you're like, okay, you're going to sit down with your traders. It's a team sport.
Yep.
And when COVID happened, we all went home. It ripped apart that relationship, that kind of bond that everyone has in trying to work out this business. Because it is something that it's an iterative approach. It's like you solve a problem and then you have to solve another problem and you keep going. You can't do that if you're not face to face. I think the biggest thing that has hurt our industry is the fact that we are not 5 days a week. I mean, we happen to be 4 days a week. I think it's probably fine, having Friday to kind of catch up on things for us. And I don't think we're going to change that. But let's put it this way. I think the more that teams can spend time together, the better. And I do believe that there's so much to learn about this business. And I look back and when you and I first started, think about how complex and sophisticated the asset management world is today with the number of different fund structures and the complex relationships that you have with your clients to build value and give them an investment option which meets all their needs. And their needs are multiplex now. So I think we're in much better shape than we were a few years ago, but I think we could do more on the mentoring side.
Where do we want to go with the lead over the next several years? Where do you guys want to take that?
Well, so we're really excited to launch it as the lead this week. And thank you so much for helping us do this. And by the way, I think that I looked back at some of the older articles that I was doing back in the old days. It brought back that kind of feeling of creativity and fun. And I remember vividly some of the things I read voraciously. People ask me, well, how much time do you spend on the lead left? And my answer is all the time, every time, every day, because in my meetings with investors, in my discussions with my colleagues, in watching Bloomberg, in all of the reading that I'm doing, I come across information that I'm like, this is crying out for us to go to investors to get them to understand what's going on. Now, it's become more challenging because everybody has so much to read, right? Think about all the things that you do to prep every morning, every afternoon for your job. Same is true with investors. So you want to grab their attention right away. We just hired Peter Repetto, who is our head of research. He came to us from iCapital, been with us for about 100 days now. I'm helping him to sort of get into a lead left mentality and how we write, how we work. And he's great. He's a great writer. He's going to be fantastic. But in doing that teaching, that's an education too, I'm relearning it myself. Like, how do I write? Why do I write what I write? What a message am I trying to get across? Because I have to tell him, Peter, here's what I'm trying to get across. What we want to do is we want to isolate ideas that create understanding to clients which may not be apparent by current commentary or hearing or reading stuff that's going on in the markets right now. And a perfect example was all the stuff last year with cockroaches and deals gone bad and First Brands and all that, which turned out it wasn't even a private credit deal, and yet we were blamed for it. That was when the lead left kicks in. That's when we start publishing things and say, let me explain to you actually what's going on. And so I think that what we want to do with the lead is, particularly with the increase in retail interest in the asset class, is to provide a place where these investors can go, where they can read the information that they're looking for with regard to the kinds of issues you and I were talking about earlier, whether it's liquidity or valuations or yields or defaults. We're doing in September, a webinar on default rates with the top 4 rating agencies in the world. And they're each going to talk about how they think about ratings. How do they calculate them? Because if you look at the differences in ratings and defaults, they're all over the map. Like one agency is saying it's 2% private credit default, and another is saying it's 6%. Who's right? So getting more information out about that, I think, is really, really helpful. But doing it in a way that's fun, that's interesting, that people want to read. So we're trying to keep it entertaining, but educating at the same time. And I think bringing this all together in a new way to streamline, I think, what we're doing. Nuveen has been a fantastic partner in this process. So they're now home for the lead, and they're going to be sending this stuff out to 400,000 of their clients. And it's going to take this to a whole new level. I could not be more excited.
And I'll tell you that, as I mentioned earlier, I think the timing for this is just impeccable because, again, more and more people are getting exposed to this asset class, and I think they need some support as they do that.
Yeah, well,
and education.
It is. And I think you want to make it fun because that's what brings them back. I was going through some of our old articles, and I remember the fun that I had writing about one particular piece. And I read voraciously about everything. And I read about the story of these two octopus who were octopi, I guess. They were in a New Zealand aquarium back in 2014, I think. And apparently one of them escaped because the aquarium guard came around and saw that one octopus was still there and one was missing. And they saw the sort of slime trail down the tank and down the drain. So the octopus escaped. Inky is Inky and Blotchy. Inky escaped down the drain into the New Zealand Bay. So this made global headlines. And I read this piece and I thought, wow, first of all, that's a crazy story. Second of all, it's interesting because Inky took off, but Blotchy stayed in the aquarium. And I thought, wonder why Blotchy didn't follow Inky.
Right.
And I realized, well, two different views of that situation. One is, I'm out of here, I'm going, okay? I see the escape route and I can go back home. The other's like, look, I've got guaranteed food. I've got more room in the tank. I'm sticking around. So in that little story, which, by the way, they made a book out of it, believe it or not, I got more mail on that column than I did because what it reflects is the way that investors think. Some follow the crowd and they think, you know what, I'm going to go jumping into this AI stuff because it seems like it's really cool. But others like, you know what, let them try that. Let me see what happens. But right now I kind of feel like sticking at home because I think I'll feel safer. And that different viewpoint of what risk is, which is apparently open to all creatures, is what investors really focus on. And we love to call that attention. So not everybody buys everything. Not everybody sells everything. But it's great to know that we're hopefully going to be around for another 18 years to talk about the differences.
Great stuff.
Paul, thank you so much.